What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone, brought to you by the Pulis Group. Today, we're going to talk about shareholder basis for S corporation owners. Now, a few weeks ago, we talked about partnership basis. The concept is the same. With an S corporation, you have basis in your shares, in your ownership in the company. There's actually two levels of basis. It's the basis in your shares, and then, as we'll talk about, there can be basis in debt when you lend to the corporation. So one of the main reasons you have to track your basis is because you can only deduct losses and take deductions to the extent you have basis. Losses in excess of basis are suspended and carried forward until you have sufficient basis in a future year to absorb those losses. So they're not gone. You think of it as a passive loss, similar to how passive losses can be carried forward. The same applies to losses that are suspended due to insufficient basis. Now, the character of the suspended loss will remain the same and can be used in the following tax year when you have sufficient basis. So it may be an ordinary loss. You could have a suspended charitable donation deduction. So it's going to remain its character. Suspended capital loss. It will still be a capital loss when you're able to use it. Now, similar to a partnership, with an S corporation, when you take a distribution in excess of your basis, the amount that's distributed in excess of basis is taxed as a capital gain. So same treatment that we have with partnerships. So let's talk about what increases and decreases your basis. Now remember, your basis can never go below zero. Once you hit zero, that's when the losses are suspended. Any distributions beyond that point are taxable. Basis, by definition, cannot be negative. So once you get down to zero, you have no basis. So there's two subsets of basis with an S corporation. You have your stock basis and your debt basis. Your stock basis is increased by contributions you make to the business, your share of taxable income and gains, your share of the tax-exempt income, if any, and your stock basis is decreased by distributions paid to you, your share of business losses and deductions, and your share of any non-deductible expenses. For example, meals. Meals are generally 50% deductible. The non-deductible portion still reduces your basis. So let's look at a quick example. Let's say you contribute $25,000 to a brand new S corporation, and you have 100% ownership. During the tax year, the business has $50,000 of taxable income and pays a distribution to you of $15,000. Your basis in the S corporation shares at the end of the year is $60,000. That's your initial contribution of $25,000 plus $50,000 of income. Now we're at $75,000 minus the $15,000 distribution paid to you. Takes us down to $60,000. So that's an example of how your stock basis works. Now let's look at how debt basis works. So when it comes to deducting S corporation losses, if a shareholder has basis in certain debt that the S corporation owes to the shareholder has loaned money to the business. This basis is also adjusted during the year to reflect repayments or additional loans that are taken out or loaned to the partnership. Unlike a partner in a partnership, an S corporation shareholder does not receive basis, or their basis does not increase for the S corporation's debt to outside lenders. So with a partnership, if the partnership borrows money from non-partners, third parties, let's say a bank, that will increase a partner's basis. With an S corporation, that's not the case. Outside lenders, that debt does not increase your basis. Only time you have debt basis with an S corporation is when you lend money personally to the business. So if an S corporation borrows money from a bank or another lender, an outside lender unrelated to the business, this business level debt does not increase the shareholder's basis in the stock. So the only debt that creates basis for an S corp shareholder are the loans the shareholder makes to the business. Now, prior to 2021, you had to use worksheets to track your basis in an S corporation. Starting in 2021, the IRS released a new form. This is Form 7203 to report basis with your return every year. So you're required to file this form in any year that you claim a loss from an S corporation, you receive a distribution from an S corporation, or you disposed of any S corporation stock, or if you received a loan repayment from the S corporation. So if you don't have any of those, then technically you don't need to file this form. It's good practice just to file and report this form every year, more for your own tracking purposes. So when you have losses in deductible items in excess of your basis in the S corporation, as we previously mentioned, those losses are suspended and carried over until you have sufficient basis in a future year to take those losses. When you have more than one type of loss or deduction that exceeds basis, those amounts are disallowed, or those amounts that are disallowed or suspended, they're allocated on a prorated basis. So let's look at a quick example of how this would work. Let's say your basis is $6,000 in the S corporation and you have an ordinary loss of $9,000 and a charitable deduction of $1,000. You can take $6,000 of that loss to reduce the basis to zero from the loss and the deductions, but it's going to be on a prorated basis. So the $9,000 of ordinary loss represents 90% of the total, because you have 9,000 ordinary and 1,000 charitable, so a total of 10,000. So you would recognize $5,400 of ordinary loss, 90% of the 6,000, and the remaining 3,600 would be carried over. And you'd also recognize a $600 charitable deduction with the remaining 400 carried over. You get a total charitable deduction of 1,000. You're able to take 10% of what's left in your basis, that your basis was 6,000, so $600 of charitable deduction, and the balance carried over. So that's what I mean. That's what we mean when it's the losses and deductions are sort of treated on a pro rata basis. We had 10,000 total, 9,000 ordinary, 1,000 charitable donation, but you only have $6,000 of basis. So 90% of that 6,000 is going to be ordinary loss, 5,400. The other 10% will be allocated to the charitable donations for 600. So to summarize, S corporation basis is similar to a partnership, but the debt's treated differently. With an S corporation, the only debt that creates basis is debt that the shareholder has where they have loaned money to the business. Tracking your basis is important because it impacts the deductibility of losses, and if you receive distributions in excess of basis, they're taxed as capital gains. If losses are suspended and there's more than one type or character of suspended loss, the example we just looked at, some ordinary, some charitable, maybe capital, then they're allocated on a prorated basis as they carry forward. So that about does it for today and our discussion on S corporation basis. If you found value in this episode, please leave a 5-star review and hit that like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.